Okay, good morning. So today we're going to get started. We're going to be talking about Chapter 11 today, which is a new chapter for us because up to this point we've worked our way through the balance sheet. So what we did is we did assets for the first several weeks, and then we did liabilities, and last week we did stockholders' equity. So we're done with the balance sheet completely. So today what we're doing is we're doing the income statement, and so we'll get to Chapter 11 in a moment. First question up is a question relating to our material from last week. The purchase of treasury stock by a corporation increases total assets and stockholders' equity. True or false? Now, when you're looking at this, you can tell yourself, if you ignore treasury stock, what it's saying is it says the purchase. When you see the word purchase, unless you're told otherwise, that implies cash. So we're buying something, we're purchasing something with cash. So cash is an asset, and cash would be decreasing from that transaction. So we go on to read this. The purchase of treasury stock by a corporation increases total assets. That fails right there, right? So, but anyways, back to treasury stock. Treasury stock is our own stock. When we go back out, if we go out and buy it, we're spending cash for it. We'll decrease total assets, and treasury stock also decreases stockholders' equity. So this one is absolutely false. It's actually the opposite, that when we purchase treasury stock, we're decreasing total assets and we're decreasing stockholders' equity. Treasury stock is a contra stockholders' equity account. So that question is going to stay open for a couple minutes. It'll close without any prior announcement. So if you're just getting here, make sure you answer that first question. And okay, so we're going to talk briefly. Okay, ready? Okay, we're going to talk briefly about the final exam. We will talk more about the exam. Talk more about the exam the week after Thanksgiving. But for right now, final exam will be available Monday through Thursday of finals week. You have to start it by 4 p.m. Thursday. That's the last time to start it. The reason I'm talking about it today is if you are in Section 7 and 8 and take your exam with ProctorU, you'll want to schedule your exam as soon as possible. Finals week is extremely busy at ProctorU. The time slots, the more desirable ones, go faster. So you will want to schedule your exam as soon as possible. You can go on any time and schedule it for within that time frame. So you want to get that done. And again, we'll talk more about the final exam after we come back after Thanksgiving. Okay, this Saturday, homework is due. And what we're doing, this is Chapter 11, and it's about the income statement and kind of a hodgepodge of items. Back to that. Okay, just a reminder, there is no class on Wednesday. This is it. So today we do Chapter 11. The homework, I have short videos, step-by-step videos. I'll be sending those out this afternoon, so you can access those. The homework is not too bad today. The homework will be, I'll get those videos out. Chapter 11. The reason we can cover it pretty much in a day with the little videos supplementing Wednesday is because we're not covering two of the learning objectives. This is from design. So learning objectives 2 and 3 are not in the exam. They're not in the homework. They're nowhere. So we're covering 4 learning objectives. We'll cover selected learning objectives in Chapter 12 as well. But what we don't cover today will be in the short videos that I send out this afternoon. So today what I wanted to concentrate on is showing you some things maybe that you don't need to take notes about, but to show you examples of what we're talking about in this chapter. So first of all, we're going to start talking about quality of earnings. And quality of earnings basically points to how well a company is doing earnings-wise, and are those earnings expected to continue? And there's 4 kind of areas of quality of earnings that we can talk about. One of them is proper revenue and expense recognition. Is the company following the rules, generally accepted accounting principles, for recognizing the revenue and expense? Do they have a high gross margin to sales ratio? Do they have operating expenses that are declining over time? And do they have a high operating earnings to sales ratio? The PowerPoints that are available on Blackboard, if you download them, have more details for each of these items. Also, the textbook does, but those are the high points. What I'm going to do coming up here is I'm going to use the Amazon financial statements that are in your book to illustrate these. So coming up here, after this slide, I'm going to show you Amazon's financial statements. You will not need to write down what we're talking about, but what I want to do is illustrate some of these earnings quality measures, how we actually do that in real life. So basically, with this, the proper revenue and expense recognition refers to, is the company following the rules for generally accepted accounting principles. For the other 3, these are ratios. We're saying, are their ratios going in the correct direction? So I'm going to be using Amazon's financial statements. I'm using the Appendix A that's in your textbook. So if you have that or you want to take a look at it later, you have it available. That's why I chose what was in your textbook. And I'm going to wait for people to write this down, and then I'm going to switch over to looking at quality of earnings for Amazon. Okay, so Amazon's earnings quality. Again, this is nothing you need to write down. You do not need to memorize this when we're talking about Amazon. But this is Appendix A in your book. It's page 827. And what we have here is Amazon's statement of operations. Now, Amazon's statement of operations is its income statement. Some companies choose to call their income statement of operation. It means the same thing. Amazon presents 3 years of income statements. That is dictated by the Securities and Exchange Commission, the SEC. The SEC says you will show this many years of income statements, this many years of balance sheet. That's all dictated by law. So this is Amazon's financial statements, and the first thing we're going to look at is cost of goods sold to sales ratio. This is a measure of earnings quality. And what we're doing here, and again, this isn't something to memorize. You don't need to write these numbers down. But what we're doing is we're taking Amazon's cost of sales. So Amazon's cost of goods sold, their cost of sales, we're dividing it by their sales for each of the years. So the first year we do it, we get 89%. What that means is that 89 cents of every sales dollar is cost of goods sold. So when you buy something from Amazon, if you were to spend $1, 89 cents of it goes to cover Amazon's cost of sales. So then they only have 11 cents to cover other things. And that's in 2012. In 2011, it was also 89 cents, or 89%, and in 2010, it was 86%. So we're looking at this from a quality of earnings standpoint, and from a quality of earnings standpoint, you want your expenses to be the same or lower, and in this case, Amazon's expenses as a percent of sales are increasing. So this is not a good indicator for Amazon, but it's not alarming. It's not a huge shift, but they're going from 86 cents up to 89. So they're holding steady from the one year to the other year. Then we switch over and we're going to look at gross margin to sales ratio. Now, gross margin is going to be gross margin is sales minus cost of sales. So we have to compute it. In this case, But gross margin is the mirror image of the cost of sales to revenue. So when we compute this for each year, in 2012 we get 11 cents. So that's saying of every sales dollar Amazon gets in, 11 cents is its gross margin or gross profit in 2012. In 2011 it was 11 cents as well, and in 2010 it was 14 cents. So Amazon's quality of earnings, looking at this ratio, not surprisingly, is also going in the wrong direction. Now look at this one. When we're looking at this one, we want this one to be going up. The one that we just looked at, we wanted it to go down. So when you look at ratios, you have to look at what you're looking at. Here we're looking at gross profit. We want gross profit to go up. The other one, we were looking at expenses. You want that one to go down. Another one we can look at with Amazon is operating expenses to sales ratios. So you know how we said in 2012, Amazon has 89 cents of cost of sales for every dollar of revenue, sales revenue. It has 11 cents left to cover other things. Those other things are operating expenses, such as fulfillment. That's the cost to get the package to you. Marketing, technology, and content. So that 11 cents has to cover all of that. And when we compute this ratio, it's 28% in 2012. It was 24% in 2011, and it was 20% in 2010. We're looking at operating expenses as a percent of revenue. So this is definitely going in the wrong direction for Amazon. We went from 20% operating expenses to 24% to 28%. So this is not a trend in the right direction. Amazon, this was 2012, and Amazon, everyone kind of struggled in 2012, and Amazon was not an exception. Just as a postscript, Amazon has done extremely well since then. In the last quarter, when they released earnings this last quarter, they blew away all analyst expectations, and their stock shot up because they are doing a lot better than anyone anticipated. So these measures are not saying doom and gloom for Amazon. They're just saying this is what analysts would look at when they're analyzing Amazon. And here's another one, operating income to sales ratio. Operating income is income from operations divided by sales, and we see it was 1.3% in 2012, 2.05% in 2011, and 4.6% in 2010. So Amazon was kind of on a decline, but then we know 3 years later, looking at it 3 years later, they have bounced back and they have actually done very well in the last year. They've had record-breaking, for them, income and earnings. Okay, so that was earnings quality, and we'll see a little bit more about earnings quality towards the end today. But earnings quality is looking at your expenses and your revenues. See, are they going in the right direction? We want to be able to maintain or improve over time. Okay, so next up, we're not doing linear objectives 2 or 3, but we're skipping to 4, which is earnings per share. Earnings per share is one of the most widely quoted statistics when you talk about a company. And basically, earnings per share is the income per share of common stock. So this formula, you will need it. It's net income minus preferred dividends divided by the weighted average number of common shares outstanding. Okay, what earnings per share is it says how much income is available to the common shareholder after the preferred shareholders are paid. That's why we start with the numerator. We start with the net income that the company, this is what the company made. Bottom line, what did they make last year or whatever year we're looking at? We're going to subtract out the preferred dividends because preferred shareholders have to be paid the dividend before common shareholders can get anything. So if we have any preferred stock, we're going to subtract out the preferred stock dividend right off the bat. Then for the denominator, we're taking the number of common shares outstanding. And we have this weighted average because if in real life, what they do is they say, well, let's take the number of shares at the beginning of the year and at different places. They calculate the weighted average number of shares throughout the whole year. In the denominator, they just don't take the weighted average number at the end of the year because the income was earned over the year. For our purpose, we'll just be given the number of shares. So the things that I want to emphasize here that we'll see coming up in a little while is that the earnings per share is per share of common share outstanding or outstanding common share. So when we talk about earnings per share, it is measuring the amount of earnings available to common shareholders, the outstanding common shareholders. We don't include treasury stock, so treasury stock reduces it. We also don't include stock that has been authorized but not issued. So it has to be the number of common shares that are actually out there outstanding. So what we're going to do now is, we have one thing. A lot of times in the press, you'll hear them talk about, or sometimes, you'll hear about earnings per share, but sometimes you hear about fully diluted earnings per share or diluted earnings per share. What that comes from is the diluted earnings per share is a what-if number. And what it does is it says, if the company's preferred stock is convertible, and when we see convertible preferred stock, that means there's some agreement on the preferred stock that allows it to be exchanged for common stock. So that's convertible preferred stock. And if that's the case, we calculate the fully diluted earnings per share or diluted earnings per share as though those preferred stock had been converted. The only thing I want you to notice, you do not need to know how to calculate fully diluted earnings per share. Right now we're not doing that, but diluted earnings per share includes the preferred stock if it were converted, basically. Okay, we're going to do an example of earnings per share. So in our example, it tells us that the balance sheet reports the following. We have preferred stock. Now preferred stock, remember, is based on a percentage, and the percentage, the dividends on the preferred stock are always going to be the percentage times the par value, which is what they're giving us the total par value right here. Okay, so preferred stock pays a percentage of par. Common stock telling us the par value, how many shares are issued, and then treasury stock. Remember that treasury stock is our own stock that we own, and it's a contra stockholders equity account. Typically, you're going to be subtracting it from common stockholders equity, and then during the year, it tells us they earned income of $6,200,000. So that's all been given to us. We need to calculate earnings per share. Earnings per share is net income minus preferred dividends divided by the common shares outstanding. So what we're going to do first is calculate our preferred dividend. Our preferred dividend will be $220,000 times 4%, 2%, to give us $4,400. So we're going to use that in the formula coming up. So the $4,400 is our preferred dividend. The other number that we need to calculate here to calculate earnings per share is going to be the number of common shares outstanding. And what we're going to do here is we're going to take the 1,100,000 shares, subtract the treasury stock shares, and we get 980,000 shares outstanding. Okay, so we've just done two calculations that we're going to need on the next example. Okay, so to calculate earnings per share, we're going to take the net income. The net income was given as $6,200,000, so that was given. Next, we're going to subtract the preferred dividend. The preferred dividend was the par value of $220,000 times 2%, or $4,400. And then we're going to divide by the number of common shares outstanding, and the common shares outstanding, 980,000. So our earnings per share is $6.32. Once again, I want to highlight when we're talking about earnings per share, it's per share of outstanding common stock. Okay? That's important to know that when we're talking about earnings per share, it's per share of outstanding common stock. That would be worthwhile to write down probably. Earnings per share is per share of outstanding common stock. Okay, so again, earnings per share is per share of common stock outstanding. Okay, so brings us to our question. So when we're talking about earnings per share is the amount of a company's net income per share of what? Okay? Okay, earnings per share is the amount of a company's net income per share of what? We just had it. I'm going to close the question in about 10 seconds. Outstanding common stock. Okay, now next up I've got a question. I want to get your kind of what you think, right, going from the get-go. Publicly traded companies have the option to produce audited financial statements. The key word here is option, okay? Publicly traded companies have the option to produce audited financial statements. True or false? I don't know how much. What was it? Okay, now, when we're talking about this one, publicly traded companies, these are corporations. So corporations in the United States are required by the Securities and Exchange Commission, the SEC, to file audited financial statements, to produce audited financial statements. So when we talk about publicly traded companies, they do not have the option. They are required to produce audited financial statements. So publicly traded companies, there's no option about it. They are required to produce audited financial statements. Going to close this in about 10 seconds. Okay, so that one's false. Okay, there is no option about it. They are required to. Okay, another one is one you have to think about here is publicly traded companies have to file their financial statements with the IRS. True or false? Okay, now on this one, so let's dissect the question. A publicly traded company is a corporation. It has to be a corporation. Publicly traded company is a corporation. A corporation files its tax return with the IRS. A tax return is a form it fills out. The tax return is not a financial statement. The tax return, what's happening is the government is requesting information so that your tax liability can be calculated. So the government will tell you what it needs on that return. It'll say, well, put your sales here. You can put depreciation calculated this way here, which is not the same as depreciation on your financial statements. So what you do as a publicly held company is you file your tax return with the IRS. Your financial statements, your balance sheet, your statement of income, your statement of stockholders' equity, your statement of cash flows, those are never, ever, ever filed with the IRS. Okay? You file your tax return. It is not a financial statement. They were talking about corporations. Corporations file a tax return. A tax return is an information gathering form. It is not your income statement. It is not your financial statement. Okay? So I'm going to close this question in about 10 seconds. So again, you do not file financial statements with the IRS, you file your tax return. So now we move on to management versus the auditor's responsibility. Okay, now publicly held companies, that's the subject of this chapter, publicly held companies. These are companies whose stock is trading, the public can buy and sell the stock. So publicly traded companies have to issue audited financial statements every year. They have to produce these financial statements. So the financial statements, these are the things like your balance sheet, your income statement, and they're all the disclosures where you're explaining what's going on, what has gone on in the past. And investors use the financial statements to make investing decisions. Now, if we were to say to companies, go ahead and produce financial statements, we'll take your word for it. As an investor, I would not be able to invest in any company that I didn't have personal knowledge of, because companies could do whatever they wanted and I would have no way to gauge whether that company was really being honest or not. So that's where auditors come in. Auditors are independent third parties. So they come in, and a public accounting firm will come in to a publicly held company and they'll do tests and they'll check things. And what they're trying to do is they're trying to determine if the results are presented fairly. Did the company follow the rules? Did the company report fairly? Does the company have adequate internal controls in place to make sure it's done right? And the auditors are that third party that comes in. So I, as an investor, know the financial statements. Somebody independent is looking at the company's work and saying, yeah, this makes sense. That gives me a lot of assurance. Otherwise, if we didn't have auditors, we would not be able to buy and sell stocks that we didn't have personal knowledge of. So our whole system of commerce in terms of investing is built upon relying on auditors. So we have management and we have auditor responsibilities. When we talk about management, we are talking about the management of the corporation, okay? And then we have the auditors, okay? But whenever we talk about management, management refers to the management of the corporation, the one that's issuing the financial statements. And then auditors are the third parties. So when we talk about management's responsibilities, management is responsible for financial reporting. It's responsible for internal control, but management is basically responsible for it has to say that it's responsible for financial reporting and internal control. So management, so the company's CEO is responsible for financial reporting, for what's presented on those financial statements. When Enron imploded, when Enron blew up and it turned out that they were just making fictitious entries, their CEO's defense for all this fraud that was going on with Enron, their CEO's defense was, I'm the CEO, those are the accountants that do the numbers, I'm not responsible. So quickly after that, Congress passed a law stating that CEOs and other upper management are responsible for the financial statements. So if you aspire to go into management someday, if you aspire to own your own business, know that you are responsible for the financial numbers. You cannot say, I do not understand accounting, it's not my fault. You are being held responsible to understand it. So even if you hire somebody to do your accounting, you still need to understand it, because as management, you are responsible for it. So as management is responsible for the financial statements. If you are an upper level manager at a company, top management, you are responsible for that company's financial reporting and for the internal controls. Internal controls is that system built to safeguard things. For example, at the grocery store, when you go to the grocery store and you check out and the cashier rings it up and there's a total in the register, and that total from all day gets added together. At the end of the day, the register is cashed out to balance. That's an internal control. Required someone to sign checks who doesn't prepare the bank reconciliation is internal control. So management is responsible for the internal control system, but they're also responsible for the financial numbers. Okay, now the auditors. So the auditors are an independent third party. What they're responsible for is, do the statements comply with generally accepted accounting principles? The audit is what adds credibility to our investing system. The audit is that linchpin that says, yes, we can freely invest in different companies that we don't know anything about, because someone is there looking over the company's shoulder to determine that it looks like everything's okay. So what I'm going to do now is, again, this I'm going to show you some things. So we have management's responsibility and we have auditor's responsibility. They both issue letters with the financial statements. So when you pick up a set of financial statements, not only does it include the financial statements, the balance sheet, the income statement, etc., but it also includes a letter from the management of the company, and it includes a letter from the auditor. And what we're going to do is I'm going to show you J.M. Smucker's letters. And again, this isn't something you need to scramble to write everything down, but I'm going to show you some examples of these. So the J.M. Smucker Company. By the way, if you ever want to see the financial statements for a publicly held company, the easiest way is to go into Google and type in the name of the company followed by the words investor relations. And that will pop up the investor relations for that company, their website. Typically it's called investor relations, and you would go into there and you look for something either called the annual report or a Form 10-K. The Form 10-K is the annual report that the company files with the Securities and Exchange Commission, the SEC. So this is Smucker's 2014 10-K, and this was filed, so this is all publicly available. And I want to just give you an idea of the length of it. So this is the letter. So this is the letter from the auditor to, and I want, this is something I would write down. So now I'm going to blow it up just to see a little bit bigger. First of all, the auditor's letter, and this is something I would write down. The auditor's letter is addressed to the board of directors and the shareholders of the company. So the auditors are writing their letter to the board of directors and the shareholders, okay? Because their audit is performed for them, okay? So the audit report is addressed to the board of directors and the shareholders of a company. Now, some things to note. This is J.M. Smucker, who is located very close to us. And when we look at the auditor's letter, the audit report, in the lower left-hand corner, you'll see Akron, Ohio, because that's where their public accountant is located, in Akron. This audit report was dated June 23, 2014, and then it's signed by Ernst & Young. So we know that's who their auditor was. So what we're going to do now, this audit report has 4 paragraphs, very standard paragraphs. So we're going to look at each of the paragraphs, and what I've done here is paragraph 1. So there's 4 paragraphs. The first paragraph, and again, this isn't something you need to write down. If you're an accounting major, you'll learn these paragraphs very well as you go forward, but this is the audit report. What does the audit report tell us? Well, the audit report, first paragraph, will tell us what they audited, what period of time and which statement. So usually it's, you know, the 4 big statements, and then here's for the last 2 or 3 years. And then down towards the bottom, it says these financial statements are the responsibility of the company's management. So company's management is responsible for the statements. The auditors are not. The auditor's responsibility is found in the last sentence. The auditor's responsibility is to express an opinion on these financial statements, whether they meet generally accepted accounting principles or not, whether they present the information fairly. So the financial statements are the responsibility of management, not the auditors. Going forward, it tells us that what framework they've used for their audit. They're using the Public Company Accounting Oversight Board, and also I put in big letters, the standards require that we plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement. That word material, or the words reasonable assurance, that's key. Reasonable assurance means that they've done testing. They have not looked at every single transaction. It simply wouldn't be cost effective. They can't go back and look at everything. So they do a lot of testing to see if we can be reasonably assured. This doesn't say that there was no fraud going on. This doesn't say that there weren't any errors. But they're saying, according to the standards that we use, we can be reasonably assured that these statements present fairly without material misstatements. Okay, and then it tells us more about the audit there. And then it says, in our opinion, so here's the big paragraph. This is where they're telling the shareholders and the board of directors, here's the result of our audit. And it's telling us in the first sentence, the consolidated financial statements referred to above present fairly in all material respects the consolidated financial position. So Smucker's got a clean opinion. They got an opinion that says, yes, these financial statements present fairly. And that's what they're looking for. This is their opinion. This is the opinion paragraph. This is what Smucker's wants. Down at the bottom, it tells us in conformity with U.S. generally accepted accounting principles. Okay, and then the fourth paragraph, we have audited in accordance with these internal control over financial reporting. So we're looking at the numbers and we're looking at the internal controls that are in place. And then we get down to the last sentence where I've blown up the words unqualified opinion. And this is a huge misnomer, but for decades, companies have strived to get what's called an unqualified opinion. An unqualified opinion means that there were no exceptions, because you can qualify something for something. Well, unqualified is what every company wants. They want an unqualified opinion. It does not mean, it doesn't mean what it sounds like it means. Unqualified means there were no exceptions. So unqualified opinion is the best. Now, a qualified opinion says, well, we found something, here's what we found. Companies don't want that because that's telling the investors something's wrong, okay? So an unqualified opinion is what companies want. Now, those words have been in play for decades, and for decades it has confused people because why on earth would you want an unqualified opinion? That sounds like somebody not qualified to give an opinion. It just sounds wrong. So finally, the standard setters have changed that, and within the next few years, the words unqualified and qualified are going away about opinions. So I think there'll be clean opinions now. Is that what they're called? Do you know? Clean? Clean? Yeah. So anyways, I just wanted to point out why the words unqualified were there. That actually is what they want, is an unqualified opinion. Okay, so that was the audit report. So those are the auditors, the independent auditors. Ernst & Young came in, did tests, tested internal controls, tested transactions, and gave reasonable assurance that things look okay. So now we look at management's letter. This is addressed to the shareholders of the Smucker's Company, and this is by top management at the Smucker's Company. And they have to write a letter, and in their letter, the first paragraph says, management of the J.M. Smucker Company is responsible for the preparation, integrity, accuracy, and consistency of the financial statements. So management is responsible, period. You cannot have a defense of saying, I don't understand accounting, or the accountants did it. As management, you are responsible. You can go to jail if things are wrong. Okay? Let's see. Next paragraph tells us we maintain our internal control system. Next paragraph tells us, that Ernst & Young has audited our financial statements. So they're saying, okay, we're responsible for the financial reports and internal controls, but Ernst & Young came in and audited. And then it tells about their audit committee at J.M. Smucker, because J.M. Smucker has an internal audit staff, and they also have an audit committee which communicates with Ernst & Young. What we don't want is we don't want Ernst & Young coming in and finding problems, and then J.M. Smucker Company saying, oh yeah, we're not going to pay our bill if you report these, so go ahead and squash everything. Ernst & Young reports to an audit committee composed of outside directors of Smucker's to try to maintain independence. And then finally, management says that it's our judgment that everything works together to provide reasonable assurance. So management's taking responsibility. Management cannot get out of responsibility. It is ultimately responsible for the numbers and for the internal control. Okay, so let's go. We have a couple of questions here. First one, an audit report is addressed to the board of directors and stockholders of the company. True or false? Okay, an audit report is addressed to the board of directors and stockholders of the company. So that's where the auditors are saying, here's what we did in our audit, here's what we found, here's our opinion, and an audit report is addressed to the board of directors and stockholders of the company. I'm going to close the question in about 10 seconds. Okay, that is true. And then one more before we go on. It is the independent auditor's responsibility to determine whether the company's financial statements comply with generally accepted accounting principles. When we talked about this, what is the auditor's job? The auditor's primary job, the primary objective, is to determine if those statements are presented in accordance, are prepared in accordance with generally accepted accounting principles. That is the auditor's main job. They're looking at that. They're looking to make sure the internal control systems support that. But their basic job, their basic objective of the independent auditor is to determine whether the company's financial statements comply with GAAP. That is their basic job. It is their responsibility to comply, to make sure the company is complying with GAAP. That's what they're there to determine. going to close this question in about 10 seconds. That is absolutely true. That's the auditor's responsibility, to make sure the financial reporting complies with GAAP and to make sure internal controls are in place to do that, to make sure the internal controls are working as they just think. Okay, now, this one, again, I just wanted to show you real briefly, we were talking about quality of earnings at the very beginning of class. This is Smucker's, who we were talking about their audit report. This is in their annual report. They prepared like a one-page financial review of 2014. And what I wanted to point out in there is they are actually in that report presenting their gross profit as a percent of net sales, and they're presenting their operating income as a percent of net sales. So they are reporting for 5 years their 2 measures of earnings quality. Also, down at the bottom of this summary, they're reporting their weighted average shares outstanding, and also assuming dilution, and they're reporting their earnings per share. So they're reporting earnings per share. Companies report their earnings per share in their annual report as well. So just a couple things from the audit, from the annual report of Smucker's. Okay, so now we have another question. The audit report is signed off by the corporation's management, confirming the audit was completed properly. So what do you think there? Okay, this question, the audit report. Okay, so the audit report is what the independent auditor prepares. And this is where they're saying, here's what we found, or here's our opinion of what went on. This is why we came in. We want to report whether the company is following GAAP or not. And so they're doing this audit report, and this is saying, is it signed off by the corporation's management? So if you think about this, would it make any sense to have management who we're reporting on sign off and say, oh, you did the audit right or not? It would make no sense for that to happen. So what we have is the audit report is not signed off on by the corporation's management. That would be a conflict of interest. The auditors or independent auditors, they form their own opinion, they write an audit report, and they address it to the board of directors and the shareholders of the company, and management of the corporation does not sign off on that audit report, because that would kind of defeat the purpose of it. Because if management had to sign off, then the independent auditor would be subject to doing whatever management dictated, and that's not the purpose of it at all. So, again, I'm going to close this in 5 seconds. Okay, now another one. And this is I want to get, okay. Which entity requires companies issuing publicly traded stock to have their financial statements audited by an external auditor? So who by law requires this? Who requires publicly held companies to have an audit? Okay. Which entity? So by law, companies are required to have an audit. This concept goes back to 1933 and 1934, the Securities and Exchange Commission Act, the SEC Act, of 1933 and 1934. So this has been a long-standing requirement. So the entity that requires this by law dictates you have to have an audit, and it dictates all sorts of things, is the SEC. So the Securities and Exchange Commission. These other things, the Internal Revenue Service, when they audit you, that is not an audit to see if you're presenting fairly according to GAAP. That's saying, did you comply with tax code? So that's a whole different ballgame. The Committee of Sponsoring Organizations, we haven't talked about at all. Financial Accounting Standards Board, what they're responsible for is creating the standards, creating the generally accepted accounting standards, but they don't require audits of companies. They create the framework that companies have to comply with. So it's the SEC is the one that is responsible. Okay, closing it in 5 seconds. Okay, and stuck in the middle here, we have an important slide, and this is correcting retained earnings. So once in a while, we've talked about we do an audit. Once in a while, the audit will find an error, or an error is found for whatever reason. And the error from a prior year affects income or expense from that prior year. So it's called a prior period adjustment. And this is when we have a revenue or expense that was recorded incorrectly in an earlier period. So what we do when we have that is if we're going to correct income or expense from a prior period, that would require an entry to retained earnings. And that's the big takeaway from that slide. I would probably write that down, that you need an entry to retained earnings to correct a prior period error. Prior period adjustments require an entry to retained earnings. Okay, so if we have a prior period adjustment, so this is maybe we found an error in income from a prior period, meaning not this year, but a prior year. We don't correct income this year, we correct income last year by making an entry to retained earnings. So retained earnings, when we have prior period adjustments, basically you can link the term prior period adjustment with retained earnings because we're going to correct it through retained earnings. So prior period adjustments need an entry to retained earnings. So I've delivered a question. I'm going to turn the screen in about 5 seconds, but there is a question out there. Okay, there is a question in Learning Catalytics related to this slide. Okay, and there it is. A prior period adjustment that corrects the income of a prior period requires an entry to what? Okay, I'm going to close this question in about 10 seconds. Make sure you've answered it. The countdown's down, on. Okay, so prior period adjustment should be linked with retained earnings in your mind. That brings us to the end of what I'm going to do today. This afternoon I am sending out short videos on the remainder of Chapter 11 so that we do not have to meet on Wednesday. So I hope you have a nice Thanksgiving, and I will see you on Monday.